a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about biotech ETFs. And biotech ETFs have been rising and significantly outperforming the broader market over the past 3 months or so. And the main reason why they are doing well is the optimism regarding rate cuts. And the Fed fund futures currently suggest about 100 basis points of rate cuts by the end of this year. And lower rates are very good for biotech ETFs for two reasons. First, these are smaller companies, and many smaller companies in this space are unprofitable. And being unprofitable, that means that they need to raise a lot of money, they need to borrow money for their research and drug development. And obviously that's easy for them when rates are lower. When rates were near zero, these companies were doing quite well. When rates are at record high levels, then it becomes difficult for these smaller biotech companies. And secondly, lower rates also increase big pharma's appetite for deals. So big pharma companies, they are currently sitting at huge cash piles, and they are looking for deals, and they're looking for innovative small biotech companies, and they need to boost their drug pipeline, both because of a large patent cliff and also because of the new drug pricing rules. So these companies are looking for deals, and we have seen that at the beginning of the year, there was a flurry of M&A in this space. And recall that at the beginning of the year, the market was pricing in 7 rate cuts in 2024, and that suddenly changed after some time. And then for some time, there were, suggestions that the Fed may not cut the rates at all. Now rate cut hopes have been going up again. And as far as innovative companies in this space is concerned, we have seen very strong innovation trends. These biotech companies have been working on new approaches to fight obesity, cancer, gene editing, psychiatric treatments. So there's no dearth of innovation in this space. Research and development remains strong. And investing in this risky space, I think ETF approach is much better because these companies, small biotech companies, they work for years on their drug developments, research, and then trials. And then in the end, either the drug works or it doesn't work. So you can either make a lot of money or you can go bankrupt. So that is why in the risky space, a diversified ETF approach is better. And we'll take a look at 3 ETFs which have very different approaches. So the first one I'm highlighting is the most popular ETF in the space. In fact, and this is one of the areas where equal weighted ETF are more popular than the market cap weighted ETF. In most sectors and industries, their market cap weighted ETFs are much larger. So equal weighting ensures that the ETF is tilted towards smaller. It's one of the cheapest in the space, with 35 basis points expense ratio, has 8.1 billion in assets currently. Now, if you want to learn more about this ETF, you can go to the quote page on Sachs.com. You can read our research report articles, and you can use the link to go to State Street, the Spider webpage for this ETF, and you can look at the approach and the holdings. So Exact Sciences, United Therapeutics, Gilead, and FB, these are the top holdings in the space. So you see those giants as well as the smaller companies as well. And at the time of rebalancing, they will all be brought to equal rates. The second ETF that I'm highlighting is market cap weighted, and earlier this was the most popular product in this space, has about 240 holdings, slightly more expensive. The ticker symbol is IBP, and this has 7.9 billion in assets. And again, you can go to the Zacks code page, and using the link, you can go to iShares webpage for this ETF. You can learn details and look at the holdings, and being market cap weighted, this is top heavy. So the 4 big companies in the space, they account for about 40% of the portfolio. So the fate of the ETF will depend more on these giants: Gilead, Regeneron, Amgen, and Vertex Pharma. The third one that I am highlighting is for ETFs who are looking for more risk and more potential returns. Also, this focuses on small and about 100 small and mid-cap stocks. And these companies looks for companies which have 1 or more drugs in phase 2 or 3 of FDA clinical trials. Has about 113 million in assets and an expense ratio of 50 basis points. The ticker symbol is SBIO. And you can go to AL's webpage for the CTF, look at their research. And if you look at the portfolio, you will see that you will see those smaller companies. In fact, you may not be familiar with these companies: Crystal Biotech and Kermes Immunovent. These are the top holdings in this ETF, and I'm also not familiar with most of these companies. So on the next slide, I have the comparative performance over the past year versus the S&P 500 index. So over the past year, the State Street ETF XPI, that returned about 28%. The Ours product and S&P 500 index, they had returns about 26%, whereas the market cap weighted ETF by iShares IBB, that returned about 15%. Then I mentioned that these have been doing well over the past 3 months. So I have this 3 months chart as well, and all 3 ETFs have been outperforming the S&P 500 index over the past 3 months. XBI is the best performer with a return of 14%. The other 2 ETFs are up about 11%, 10-11%, and the S&P 500 index is up about 8% during this period. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything, and I'll see you next week.